you're a dentist looking into infinite banking, do not make this mistake. One of the biggest mistakes that you could possibly make when looking into infinite banking is thinking that higher returns means better, aka chasing returns. That is not what you want to do. Returns are an aspect of infinite banking, no doubt, but that's not the main focus of it. And if you're solely looking at what's the highest rate of return I can get inside of my policy, you're gonna overlook a lot of other critical aspects to this concept, and that could lead you into a lot of trouble. And I'm speaking from experience. One of the biggest mistakes I made in the beginning was getting more focus on higher rates of return, and that led me down a path that I do not want you to go down. So what is that path? So when you're doing infinite banking, biggest thing is what type of policy that you're using, the type of life insurance policy. So infinite banking can technically be done with anything, but most commonly you'll see it utilized with whole life insurance policies. And I have other videos really deep diving as to why, and I'll touch on that a little bit. But the biggest thing is you want to be using the right type of life insurance policy, which is whole life, to do this. There's a lot of people online that push and promote using Index Universal Life or an IUL for infinite banking, and that is a big no-go in my humble opinion. And there's nothing, it's not really humble, but why I'm saying that is because the whole point of infinite banking, let's take a step back, is you're essentially taking back the banking function in your life. You're taking back control of the banking function. You're mimicking and modeling exactly what a bank does. So with that in mind, that control piece is what we're striving after. We want control over our money. We want control over the financing aspect of our life. We don't want the control in the hands of a bank or another third-party lender. So with that in mind, you need to focus on, okay, what asset or what vehicle out there is going to give me the most control over my money, and it's a whole life insurance policy. Okay, so with an IUL, an Index Universal Life, what you'll see online is, number one, there's a lot of hype around it. They look very good on paper. Like, I could pull up an illustration right now and make it look like the best thing since sliced bread. I mean, you can really, like the back end, if you're an agent or you're licensed, you have access to illustration softwares to design the policies. And you can go in there and tweak them and make these illustrations on paper look fantastic, okay? But the issue with that is it's not reality. And again, going back to the control piece, with an IUL policy, you're giving up a lot of control, or you don't have as much control as you might think with an IUL policy. So just to dive into that a bit, and this is going to get a little bit technical, but it's very important for you to know as someone who's looking into infinite banking, because again, I wish I knew this in the beginning, because I wasted so much time going completely down the wrong path, getting an IUL policy, when in reality what I really wanted was a whole life insurance policy. The first thing I want to touch on with the IUL is, in terms of lack of control, is how you actually get that rate of return. So you don't have any say over what you're gonna earn there, okay? The way the cash value grows in IUL is it's tied to an index or multiple indexes. So your money's not directly invested into the market, you're indexed to it, meaning you capture some of the upside of however that index performs. But if the index goes negative or goes down, you have what's called a 0% floor. Some cases you might even have like a 1% floor. So essentially you're not losing any money due to market loss. Okay, and I'll touch on that more in a second. The biggest thing is the unknown. Like, we don't know how these indexers are going to perform. They could do really well. You might get a 10-20% return, but you also might not get any return. So when we're doing infinite banking, we need something that's consistent and predictable year over year. With whole life insurance, and I'm going to be bouncing between the two so you can really see the comparison. With whole life insurance, you're not going to get a 10% return, or you don't have the potential to get a 10%, 15%, 20% return, but you're going to get a guaranteed rate of return on your money every single year, which is usually, depending on the company and product, between 3 and 4%. And then if you're with a mutual insurance carrier, which we only recommend, and that's the only carriers we work with when we're setting up a policy for infinite banking, is you'll get a surplus on top of that. So you're gonna get a guaranteed rate and a surplus, which might come out to be around 5-6%. And keep in mind that 5-6%, that is a gross rate of return. So after you take out insurance costs and fees, you might be looking at more of a 3.5, I'd say 3.5 to 4.5, maybe 5% net internal rate of return. So that's your true after tax, after fees return that you're getting on your money, which is the only number that really matters at the end of the day. It's more concrete. Like there's no like, oh wow, I have the potential to get a way higher return. Like you know what you're gonna get with a whole life insurance policy, which is good in this case. Because again, when we're banking, we need things to be stable. We need our foundation to be stable. We can't have things shifting around. So we can extrapolate out, at least on the guaranteed side, like, okay, if I'm gonna get a guaranteed rate of 3 or 4 and I'm putting in X amount of money, I know exactly how much I'm gonna have 20 years from now. With an IUL, that's never the case because your money's tied to the index. We don't, unless you have a magic ball, a crystal ball, you're not gonna know how the indexes are gonna perform year over year. So when you're looking at an IUL policy and you look at the illustration, it's gonna show you that you're getting 6% or however the illustration was set up. Usually it's around 6%. It's gonna show you that you're getting 6% every single year for the life of the policy. You and I both know that's not reality. There's no possible way the S&P 500 or whatever index you're tied to, most commonly it's the S&P, is going to reduce or produce a 6% yield every year. Some years it's 20, some years it's negative, some years it's 0, it's 1, it's 2, it's 5, doesn't matter. It's different every single year. So that's a big reason or big issue I have with IULs for infinite banking, and why I don't recommend it is the unpredictability of it. It could, and I will say this before I move on to the next part, it could perform better than expected. But again, do you want to gamble when it comes to utilizing the infinite banking concept? No, you shouldn't be gambling. And even if it happened to work out for you, I mean, bravo, but the chances of it working out are slim to none. So that's just one of the variables that changes, and that's just the return aspect. The other variable is what's called your cap rate. Most of these IUL products have what's called a cap rate, and that's essentially the ceiling on your earnings. To keep it very, very simple, if you have a cap rate of 10% and your index, let's say you're tied to the S&P 500, the index performs 20%, you're not gonna get all 20%, you're gonna get 10% up to that cap rate there. So that's just something to keep in mind, is that's your ceiling, but the issue that comes to hand is the insurance carrier can adjust that cap rate. So again, it leads back to a conversation of unpredictability and shifting variables. The insurance carrier, and if you look at carriers over time, they typically reduce the cap rate. So if you got a policy today that had a 10% cap rate, who knows where it's gonna be in the future? And again, looking back at history, typically they reduce them. So 5 years from now, you might have a cap rate of 8%. And that's gonna throw off your projections from when you originally got the policy. So if the cap rate changed and it went down, let's say, and the indexes didn't perform as well as expected, now that's a double whammy, and that's gonna really, really impact the performance of the policy. And the third piece I wanna touch on is the rising cost of insurance inside of an IUL policy. And before I get into that, let me actually take a step back. Let me make the comparison to a whole life on the second point. With whole life insurance, there is no cap rate. There are some cases where you can tie a whole life insurance policy to an index like the S&P 500. Not very common, not a lot of there's only a couple carriers and products I can think of that actually allow you to do that. And essentially it's where you still get the guaranteed rate of return, but instead of taking the dividend, you can elect to tie that to the S&P 500. And I have another video I made a while ago talking about that, but just know that's a big difference is there's no cap rates with whole life insurance. The next thing I wanna talk about, and this is where this could really come to bite you later down the road when you get older, is with IULs, there's a rising cost of insurance. The cost of insurance goes up every single year. So every single year you get older, the insurance cost goes up. And what does that mean for you? That means there's more pressure on the policy to perform, because of your rising internal costs. So when you have rising costs and your policy is continuously performing and doing well, that's not a big deal. But when you have down years and the policy's not performing as expected, especially when you're in your 60s, 70s and beyond, that's where you really need the policy to perform, and that's when your cost of insurance starts to really go up. So if your cost of insurance starts to really go up and the policy's not performing, that's going to eat into your cash value, and that's where you could potentially see your policy exploding, or rather imploding on you, and you don't want that to happen. So that's a big thing with Index Universal Life, is that you have that rising cost. So that's 3 shifting variables we just covered, and again, that's not, in my opinion, that's not worth it. It's not worth it to have all those shifting variables to potentially get a higher rate of return when you've got something like whole life insurance that it's very predictable, it's stable, it's stood the test of time, it's been around for well over a century, and these companies that you can, or these carriers that you can get these policies with, these mutual carriers, they've been around, some of them 150 plus years. So that's what we're looking for when it comes to this concept. We need something stable, concrete. It's going to be there when we need it most. We don't need to play this game of chasing higher returns, even though someone on TikTok or YouTube might have positioned it in a way where this sounds so good. But I'm telling you, that is one of the biggest mistakes I've made just in my financial life overall, is going down the path of IUL, when for my values and what I was looking to accomplish, a whole life insurance policy made so much more sense. I was looking to do the infinite banking concept. So whole life, that's where it came into play. Now, I'm not saying IULs are bad, by the way. I think IULs have a great use case, just not for infinite banking. Just like any product, there's no one size fits all. I don't think there's a bad product. I think there's bad use cases. And there's a saying, like, if there's one last thing I want to leave you with, is there's a saying, if all you have is a hammer, everything looks like a nail to you, right? Well, there's a lot of insurance agents out there that all they're trained on to sell is IUL. So in their mind, they're thinking, okay, I've got this hammer, which is my IUL. That means in every single scenario, I'm going to try to sell this IUL. All I see is nails in every client interaction. And especially when it comes to infinite banking, which again, it's just a big no-go. You want that peace of mind, you want the stability and the guarantees that whole life insurance and the track record and proof of performance that whole life insurance offers. So for you dentists out there, please, I implore you, do your own research, number one. But you can go to my channel. I have lots and lots of videos talking about infinite banking and whole life insurance. So if you've been looking into it, check those other videos out. If you did get some value from today's video, you can go to the description, and at the top, you'll see my calendar link. If you want to book a call with me, we can really sit down, look at your situation, figure out, does this even make sense for you? And I'd be happy to answer any questions you may have as well, because education is key, and that's one thing I'm a huge proponent of. And I encourage you to ask a lot of questions, and if you're someone who needs to essentially see under the hood and know exactly what's going on, I really encourage that, because I'm that type of individual. Like, I want to know the moving pieces. Now, if you're not that type of individual, you just want to know, hey, is it set up, like, I trust you, it's set up correctly. If you just want to know that, and it's like, I don't really care about the moving pieces, I just want to know what it's going to do for me, that's completely fine as well. But just don't be afraid to ask questions. Take your time to get educated with this. But again, you can book a call with me. I'd be happy to have a chat there. And then lastly, you'll see a recommended video in the corner. Click on that, and I'll see you in the next one.